Good day. We are Air Capital. Welcome to our 2025-2026 CQA Investment Challenge presentation. Over the next 10 minutes, we'll walk you through our strategy, our portfolio, and the performance that we have achieved. We are students from Ashesi University in Ghana who are united by our passion for disciplined investing. So what we bring together is an analytical thinking and diverse perspectives to build a high conviction market neutral portfolio. Our mission is to generate a consistent market independent alpha by combining factor driven stock selection with strict beta neutrality and disciplined risk management. We strive to uphold the highest standards of intellectual rigor and transparency, building a strategy that can perform across all market environments. Our team includes
Salmayeng Saruna, and I was in charge of the portfolio strategy.
I'm Judith Yabibi Apia, and I was in charge of portfolio construction and analytics.
I was in charge of trade execution and performance monitoring.
Alessiara Kafui, and I was in charge of risk and compliance management.
And myself, Todiona Shichamisa, I was in charge of equity research.
So our investment philosophy was built around a market neutral relative value strategy. So rather than trying to predict the overall direction of the market, our goal was to generate returns through stock selection by identifying companies that are likely to outperform their peers while shorting those expected to underperform. To achieve this, we maintained a balanced portfolio of long and short positions, and this helped us to minimize exposure to overall market movement. On the long side, we focused on defensive and value-oriented companies with stable earnings, strong balance sheets, and consistent cash. And on the short side, we targeted cyclical and interest rate sensitive companies, particularly those exposed to housing activity. For our investment process, we began with idea generation, where we identified sectors likely to outperform or underperform based on macroeconomic trends and valuation signals. We then performed fundamental and relative value analysis. And then we constructed a portfolio with balanced long and short exposure. Finally, we continuously monitored and rebalanced the portfolio as valuations converged, macroeconomic conditions shifted, and risk exposures changed.
So we built a market neutral portfolio consisting of 90 positions. These were 45 longs and 45 shorts. Now the goal here was to balance risk while still capturing relative performance opportunities. In terms of allocation, the portfolio was primarily concentrated in large cap companies, which make up 77% of our holdings, with smaller allocations to mid cap and small cap firms to maintain diversification. Now, from a sector perspective, we took long positions in the technology and banking sectors because of their strong growth outlook and resilience in the current macroeconomic environment. On the short side, we targeted consumer goods companies and firms that were more vulnerable to trade war pressures and also potential supply chain disruptions. Now, we actively monitored the portfolio on a daily basis and rebalanced weekly based on 3 key signals. The first being company earnings updates, the second being shifts in market sentiment, and the last point being changes or major policy changes. Now, this disciplined approach resulted in a total of 210 trades throughout the simulation. And this approach gave us the perfect opportunity for us to maintain diversification while still dynamically responding to market developments.
In order to understand the risk which was associated with our portfolio, we used the Axioma report, and this was as at February 14th, 2026. So our portfolio had a total active risk of 14.24%, and this represents the volatility of our portfolio relative to the benchmark. Our historical beta was 0.04%, which indicates that our portfolio has a very low sensitivity to overall market movement. This also suggests that our portfolio returns are primarily driven by our individual stock selection. In terms of our downside risk, we had a total value risk of 5%, which is approximately $23.4 million, meaning that under normal marketing conditions, there's only a 5% probability that losses could exceed this amount over the specified horizon. Decomposing our risk, we have two sources, which is the specific risk and the factor risk. And our specific risk was around 50.6%, and our factor risk was 49.4%. Moving on the left side is a style factor chart, and this highlights our portfolio and how it was exposed to different investment characteristics such as the momentum, the size, the leverage, and liquidity. The distribution of these exposure reflects our portfolio's positioning across our different investment styles. On the right side is the sector aggregation chart, which illustrates our active sector weights related to the benchmark. So our portfolio shows meaningful exposure across sectors such as information technology, consumer discretionary, and industrials. And this reflects our focus on sectors where we identify strong stock-specific opportunities.
Now let's start with an overview of our portfolio performance. Here, our portfolio performance has a net positive return of 1.6%. This started with although our portfolio started with a slow growth, our continuous rebalancing and flexible strategy propelled our portfolio to be on par and even at times above the S&P 500. Our gains can be attributed to our diversification of our portfolio. Here we invested in multiple stocks across information technology, finance, utility, and many other sectors. Leveraging the diversification, the strong benefits or the strong gains from the energy sector as well as the technology sector propelled our investments further. However, the losses were primarily focused in our short positions, where the repricing of undervalued or often undervalued short stocks led us to have or incur significant losses, as well as investor uncertainty and sentiments regarding the AI boom or bubble. Here, we would like to break down our portfolio returns further. Here, majority of our returns can be attributed to our long positions. Here, where our long positions attributed to 61,647, where our short position only generated a return of 9,242. Now, concerning our portfolio returns, I'd like to give a breakdown. Here, majority of our returns can be attributed to the technology sector, where this can be attributed to the significant AI boom or investments, as well as the significant profits from the AI data centers. However, our losses from the energy sector could be attributed to the significant uncertainty as well as investor uncertainty as regarding the policy changes. Considering our investments, to further break it down, our major profits was attributed to Sandex Corporation, which was a company in the information technology sector. The significant increase in its value was attributed to the rising demand for the NAND flash disks, which is an essential component for the building of AI data centers. ExxonMobil was also another company in the energy sector, which experienced significant gain due to the rise in the oil prices. Thank you.